In December 2022, the United States added a Chinese chip company to its entity list, cutting off access to critical design software and manufacturing tools. Most experts predicted this would kill the company within months. Instead, something extraordinary happened. Cambricon didn't just survive. It posted 2.88 billion yuan in revenue and 1.38 billion yuan in net profit in the first half of 2025 alone. This is the story of how a company founded by two prodigy brothers turned America's harshest sanctions into their greatest competitive advantage.
Without us there, they will obviously have their own alternatives, and they've been growing. And you've seen some of the AI chip companies had record years. Their stock prices are record high.
Chen Tianxi left the Chinese Academy of Sciences with a clear goal. With Chen Yunji, he had built the Dian Now series at the Institute of Computing Technology. These were real chips, not just papers. They could run neural networks faster and use less power than many existing options. He knew papers alone would not fix China's chip reliance. China needed products that could compete with Nvidia and Intel. Companies needed chips they could buy and deploy, so he chose to leave academia and start a business. They named it Cambricon, inspired by the Cambrian period. The idea was simple: trigger rapid growth in specialized AI chips, build many targeted processors for real workloads. Their view was direct. To be secure and independent, China needed control over core components. If foreign suppliers could cut access, then critical systems were at risk. Relying on overseas processors meant vulnerability during political tension. This was not abstract. Export control had already hit Chinese tech firms. They believed China could not base its AI future on chips it did not control. Their research showed Chinese teams could design top-tier AI processors. Dian Now met global standards, turning prototypes into products. Though required more than labs, they needed manufacturing partners, customers, and a business plan that could face global competitors. Huawei became the key partner. It was expanding from telecom into consumer devices and building the Kirin platform. The team faced a choice on AI processing. Phones now relied on machine learning from camera, speech, and more. General-purpose mobile chips were not ideal for these workloads. Cambricon A1 matched Chen Tianxi's goal: real AI hardware for real products. It was not a lab demo. It was built for terminal devices like phones and tablets. While others tried to bolt AI onto existing CPUs, Cambricon designed for neural networks from the start. The result was strong performance per watt. Phones could run complex models without heavy battery drain or heat. On paper, the partnership looked unlikely. Huawei was a global leader with strict standards. Cambricon was a young company with research success but no commercial record. Huawei tested the chip. The results met their bar. In 2017, Huawei integrated Cambricon 1A into the Kirin 970 as the neural processing unit. This was not a small pilot. It shipped in flagship phones reaching millions of users. Both sides gained. Huawei phones delivered features like on-device translation and advanced photo modes. Cambricon proved its chips worked at scale in consumer products. The news spread fast. Other phone makers asked about the chips. Cloud providers explored deals. Investors lined up. Huawei's support was important because the company is known for its strong engineering standards. The deal boosted Cambricon's credibility and helped close early funding. Cambricon's status changed. It moved from academic spinoff to a credible chip vendor. Valuation passed $1 billion. Policymakers added Cambricon to plans for domestic chip capability. Momentum built. The chip had passed real-world tests across millions of devices. This opened doors that a peer research group could not access. By 2018, policy support, growing AI demand, and trade friction created a clear path for local chip makers. Three key forces set up Cambricon for a bigger role. Made in China 2025 made chips a top priority. Leaders saw reliance on foreign processors as a risk. Major Chinese tech companies used designs from the US and factories in Taiwan or South Korea. This reliance meant export controls could disrupt important systems. The plan put large resources into building the domestic chip supply chain. Cambricon fit this shift. Its AI chip matched the processing needs China wanted to handle on its own. Officials saw the company as a strategic asset. Backing from state-linked funds and CAS-related investors, including the National Semiconductor Fund, provided capital and access that strengthened its position. AI adoption grew. General CPUs were not suited for heavy AI tasks. Companies saw that AI worked best with dedicated accelerators. Demand for this hardware increased quickly, giving local specialists more opportunity. US-China tension increased the risk of relying on foreign chips. Export policy now looked like a national security issue. Chinese companies realized that US semiconductors could be cut off suddenly. Choices moved from just price and performance to concerns over supply control. This changed how investors and customers saw Cambricon. It was now less about specs and cost. The company gave buyers stable access, even during political tension. Many chose Cambricon for the steady supply, not just for technical reasons. Government support helped Cambricon move faster. The company gained access to research, manufacturing, and early customers that would take years to develop on its own. State firms began using Cambricon chips. Universities started projects with their technology. This support improved the products and spread use. Cambricon's messaging also changed. The company was not only selling chips, it was helping China reach tech independence. Each customer and launch became a sign of progress. By 2019, the shift was clear. Cambricon grew from a profit-driven startup to a national project with much larger goals. Cambricon's IPO on July 20, 2020, delivered strong market validation. Listed on Shanghai's Star Market, it raised about $369 million, with a sharp first-day rise. The signal went beyond standard financial metrics. Revenues were modest and the company was still losing money, yet demand from banks and institutions was high. The prospectus pitched a large AI market in China and placed Cambricon as core infrastructure. Cloud providers needed accelerators for machine learning. Automakers needed chips for real-time neural networks. Smart city projects needed hardware for sensor data and computer vision. Investor interest was not about near-term earnings. It was a bet on Cambricon's role in China's technology base. The company stood for efforts to build independent AI capabilities that could compete with US firms. Analysts noted a high valuation versus current revenue. Technical experts pointed to patents, engineering talent, and policy support. Skeptics warned about competition and execution risk. Nvidia led the AI chip market with strong tech and deep customer ties. Intel and other US firms had large R&D budgets and manufacturing strengths. Global coverage raised the IPO's profile. Western outlets began to treat Cambricon like a real challenger. The capital raised expanded Cambricon's options. It could fund larger R&D programs, recruit top engineers, and build stronger manufacturing and supply chain links to improve cost and output. The IPO made Cambricon a public symbol of China's push for semiconductor independence. Product news, customer wins, and setbacks would all be read as signs of progress or strain in that effort. The first setback came from Huawei. In 2018 through 2019, it shifted from Cambricon's processors to its own high silicon designs. This wasn't a slow change. Orders dropped sharply. The business model that depended on Huawei broke, and revenue fell fast. For Huawei, the move was logical. It wanted in-house chips to control design and protect supply. For Cambricon, losing the main customer also meant losing the proof point that helped win others. Then a larger hit arrived. December 2022, the United States put Cambricon on the Entity List. This got access to key design tools and advanced manufacturing. It was not a minor trade rule, it blocked core inputs needed to build modern chips. The listing stopped purchases from EDA tools from Synopsys and Cadence. These are required for advanced processor design. It also blocked work with TSMC, pushing Cambricon to rely on SMIC. SMIC's nodes trail TSMC by several generations, forcing use of older processes. Together, these shocks created a survival crisis. Cambricon lost its biggest customer and top-tier tools at the same time. Staff questioned whether the company could stay competitive. Investors questioned the broader thesis of domestic chip self-reliance. U.S. policy aimed to slow China's progress in AI and chips. Officials viewed firms like Cambricon as strategic competitors and moved to limit access to critical tools. Analysts split on the outlook. Some said the loss of U.S. technology would cause lasting damage. Others said it could speed domestic development by pushing local tools and capacity. The response inside China accelerated support for independent alternatives. Cambricon's leaders had to rethink the plan. They couldn't depend on partners that might switch suppliers. They couldn't rely on foreign tools that could be cut off. The company needed a model built for full self-reliance in design and production. This point would either end the company or push it to find a new way to compete. Cambricon's response showed a key lesson for survival in tech. Turn sanctions into a moat with two moves: software lock-in and partnerships that raise switching costs. Top tech companies don't win only with better hardware. They win by building ecosystems that developers stick with. Nvidia's lead in AI is not just fast GPUs. CUDA made their hardware easy to use. Cambricon took this lesson when facing its crisis. Most chip firms focus on speed and power. Cambricon could have chased Nvidia's architectures or Intel specs. It chose a different path. Don't try to beat CUDA globally. Win at home by locking in Chinese developers and cloud users with domestic software stack and tight partnerships. CUDA is powerful because developers write code once and run it across many GPUs. The docs are strong, tools are mature, the community helps. Leaving CUDA means rewriting code, retraining teams, and changing workflows. These switching costs keep customers in Nvidia's ecosystem even when other hardware looks better. Cambricon aimed to build the Android of AI chips for China. This meant a full software platform that made their hardware the easy choice for local developers. They invested in tools, documentation, support programs, and education. Partnerships showed the depth of this plan. Inspur integrated Cambricon stacks into its AI servers. Alibaba Cloud offered Cambricon instances. Tencent Cloud added similar options. Major domestic models, DeepSeek, Alibaba's Qwen, and Tencent's Hunyuan began optimizing for Cambricon's architecture. This strategy was about defense as much as growth. Software lock-in would protect Cambricon even if rivals shipped stronger chips. Teams that learned Cambricon's tools and shipped on its stack would avoid switching due to costs and risk. H1 2025 results surprised the tech industry. Revenue reached 2.88 billion yuan in 6 months, about 4,300% year-over-year growth. This wasn't gradual progress. Cambricon moved from losses to strong profits in a short time. This was the result of years of planning. The ecosystem strategy built real switching costs and loyalty. Customers were no longer just buying chips, they were choosing a full platform. Growth came mainly from cloud products, especially cloud AI chips and inference. Large new clients drove the jump as firms shifted from foreign chips to local options. The choice was practical. Developers shipped faster. Ops teams got better support. Finance teams liked predictable pricing. ByteDance was reported as a key customer, using Cambricon for core infrastructure. ByteDance runs heavy AI workloads for TikTok and other apps. This win signaled technical credibility and pushed other big tech firms to evaluate the platform. Patents helped protect margins. With about 1,500 patent cores, Cambricon made direct copying harder and forced rivals to develop their own IP or license it. This bought time to keep improving the products. Operational efficiency also improved. The company focused on features that customers valued. Domestic foundry partnerships matured, with quality and yields that supported profitable scale. This financial turnaround positioned Cambricon for expansion opportunities that would have seemed impossible just years earlier. The question now wasn't whether they could survive as a domestic alternative, but whether their model could scale globally.